Today, we're kicking off a 5-part video series on Medi-Cal in California, starting with one of the most important topics, eligibility. Who qualifies? What's changed and what to watch moving forward? So first things first, what exactly is Medi-Cal? Medi-Cal is California's version of the federal Medicaid program. It provides free or low-cost healthcare to low-income individuals, families, seniors, and people with disabilities. It does more than that, but that's what we're going to cover here. When we talk about eligibility, we're talking about whether someone meets certain requirements, mainly income, assets, means what you own, and sometimes medical need. For example, a 35-year-old man working part-time with limited income might qualify based on income alone. A 78-year-old woman in a nursing home might need to meet both income and asset limits. These rules matter because if you or a loved one needs help paying for care, understanding exactly where you fit in these categories can make all the difference. There are many Medi-Cal programs, but they can be broken down into a few simple types. Number one, Medi-Cal for long-term care in a nursing home. This program pays for care for someone who needs nursing home care for more than about 100 days. Not all nursing facilities accept Medi-Cal benefits, and not all people qualify for Medi-Cal. Next, Medi-Cal healthcare for aged, blind, and disabled. This program provides healthcare benefits for people who are considered disabled, who are blind, and who are over 65. Medi-Cal healthcare based on modified adjusted gross income, or MAGI Medi-Cal. This program gives healthcare to people who have some assets but low income. Then there's Medi-Cal with a share of cost. That means that you have more income than you're allowed to have under a normal Medi-Cal program. However, you pay a part of Medi-Cal's costs that they pay for you. There are several other programs like SNAP, which is food stamps, healthcare for foster children. We won't cover those in this discussion. Each of these programs has a different financial eligibility, meaning you can have a certain amount of income and a certain amount of assets, but it can be different between different programs. Don't think that one answer fits all programs. You must understand the program that you're applying for or the program that you receive in order to understand your eligibility. We can't cover eligibility for all these programs in one video, but we will explain financial eligibility for Medi-Cal long-term care and Medi-Cal aged, blind, and disabled benefits. So let's go through the basics. What's changed recently? For Medi-Cal aged, blind, and disabled, you qualify for Medi-Cal with no share of cost, meaning you don't have to pay any part of it if your income is roughly 138% or less of the federal poverty level. That's for individuals. For families and children, the limits are just a little bit higher. Any income above that amount is owed as a share of cost, like a copay, except the copay is everything above that minimum amount. That amount, 138% of the federal poverty level. As of this year, that's $1,801. A share of cost is like an insurance copay. In health insurance, the insurance company pays a certain amount for treatment, a visit, a prescription, a hospital stay. You pay a copay, which is a partial payment. With Medi-Cal, share of cost is a payment of everything above the baseline income. So if you're a single person on Medi-Cal for the aged, blind, or disabled, and you have income of more than $1,801, you have to pay everything above that until Medi-Cal begins to take over. So for example, if you have income of $3,000 per month and Medi-Cal services average $4,000 per month, you would be assessed a share of cost of $1,199 per month. You get to keep the first $1,801 of income, then you pay the next $1,199 toward your medical care. Medi-Cal would then pay the remaining approximately $2,801. That's a lot of numbers, but what it really means is this. If you have income above that baseline amount, you pay a share of cost equal to the amount over $1,801, up to the total cost of care, and then Medi-Cal takes over. That's severely limiting for people that might have $5,000 of income per month. Could they have a share of cost of more than $3,000 a month? The answer is yes. At that point, it might be important just to buy your own medical care. Do you want free medical care and then have to pay more than $3,000 a month for that care? Maybe you should just buy insurance. Maybe it's cheaper. This is where it's important to understand your rights, your responsibilities, and what you have to do. And so there's some people that actually private health insurance is better. For Medi-Cal long-term care, that's care in a nursing home, the share of cost is much more dramatic. An ill person gets to keep $35. That's it. Everything above $35 is paid as a share of cost. But there are some exceptions. One major one is any expenses that are paid for medical care. For example, if someone's receiving Medi-Cal long-term care and has vision-based health insurance, all of the copays, as well as the insurance premiums, as well as the additional costs for the glasses or the prescription, all of those are considered medical expenses, and so you get to keep that money. The reason why is because Medi-Cal would prefer that you spend money on your medical care so that Medi-Cal doesn't have to. Another good example of this is as you have dental insurance. Sometimes people have health insurance. You're allowed to keep it. Medi-Cal says that either you can pay the cost of Medi-Cal or you can pay the cost to the insurance company. Either way, Medi-Cal says you get to keep this money. That includes private expenses. So for example, if someone has to pay for adult diapers, if they're unable to control their bladder or other things, then the diapers are actually considered part of medical expenses they get to keep. You have to prove that to Medi-Cal, but it's not included in the share of costs if it can be proved. To make this even more complicated, if you're married, your spouse gets to keep a certain amount of income before paying a share of cost. That's called the minimum monthly maintenance need allowance. Say that 3 times fast or you get a prize. For asset limits, meaning things that you can own, this is where things used to get tricky. Medi-Cal used to look closely at what you own: cash, savings, investments, real estate, extra things. But here's one of the biggest updates. Before 2023, California required that most people receiving Medi-Cal had less than $2,000 of non-exempt assets. There's certain things that are exempt. Exempt assets are things that you can keep regardless of whether you get Medi-Cal benefits or not. And Medi-Cal completely ignores these. You can have a home, you can have one car, you can have property in a trade or business, you can have a burial insurance policy or a burial plot. And you can also have retirement accounts if, and only if, those retirement accounts are paying regular distributions to you. On January 1st, 2023, California expanded full scope Medi-Cal to include all adults, regardless of their assets. This is what used to make things tricky. Medi-Cal used to look closely at what you own: cash, savings, investments, a home, extra property. Before 2023, Medi-Cal had 2 different types of assets that they looked at. They looked at assets that were ignored, also called exempt, or they looked at assets that were counted, also called non-exempt. It's simply their legal way of saying these things are ignored and these things are not. The ignored property includes a home, like a place that you might live, property used in a trade or business, for example, if you're a plumber or if you have a restaurant, a burial plot or a burial insurance policy, retirement accounts that are paying regular distributions to you. That means not distribution at one time, but they're continuing over a long period of time. And then finally, personal items. Personal items that aren't of severely high value. One more thing is a car. You can have one car. That means that the things that were not ignored were a second car, a second property, any cash, savings, or investments that you had. Anything other than what was ignored, you could have a grand total of $2,000 of those things. If you had more than $2,000, you could not qualify for most Medi-Cal programs. Since January 1st, 2024, California expanded Medi-Cal to include all adults regardless of the amount of their assets. So now Medi-Cal ignored everything. But based on this expansion, so many people signed up for Medi-Cal that California started losing too much money on Medi-Cal benefits. And so now the rules have changed again. Starting January 1st, 2026, for most programs, eligibility is based on income and assets. Eligibility used to be based on income only through December 31st, 2025. So during that temporary period, most Medi-Cal programs did not count your assets, meaning savings accounts and other property would not disqualify you. But starting January 1st, 2026, asset limits were reinstated. A single person can now have up to $130,000 of non-exempt assets and still qualify. Non-exempt means assets that are counted, such as savings, investments, a second property, or retirement accounts that are not paying regular distributions. Some assets are exempt. So again, you still get to keep one home, one car, property used in a trade or business, personal items like clothing or furniture, and retirement accounts if they're paying regular distributions. Anything else that you have are capped at $130,000 of assets. A single person will be able to keep up to $130,000 of these assets. A married couple, they could keep more. Let's make that a little bit clearer with an example. Imagine Maria, a 62-year-old single woman, has about $20,000 in savings and earns $1,500 a month. Under the old rules, meaning the rules pre-2023, her savings would have made her ineligible for most Medi-Cal programs. But under the 2024 and 2025 rules, she could still qualify because Medi-Cal only looks at her income, not her savings during that temporary period. That gave families a temporary window to qualify more easily than before. So what happened next? What changed after that? Here's what you need to know. The income-only rule, meaning the no asset test, stayed in place through December 31st, 2025. Starting January 1st, 2026, California brought back certain asset limits for certain Medi-Cal programs, especially long-term care. For example, if you or a loved one needs nursing home care in 2026, A single person will face an asset limit of about $130,000. So let's take example number 2. Robert, age 80, is living at home but needs a lot more care. If his family waits until 2026 to apply for medical for nursing home coverage, and he has $150,000 in savings, that amount would now need to be evaluated under the reinstated asset limits. But if they had applied in 2025, while the income-only rule was still active, he likely would have qualified. So timing really matters. Another change to watch is immigration status. Beginning January 1, 2026, there may be limits on Medi-Cal for certain undocumented adults. This means if you qualified under the prior rules, applying before those changes took effect could have made a difference. But this is not necessarily permanent because Medi-Cal requires periodic redeterminations to confirm ongoing eligibility. So if someone went on Medi-Cal under one set of rules, they may not automatically remain eligible if their situation changes. That's why it's important to understand how these rules continue to evolve. Let's do a quick recap of what we covered today. Medi-Cal is California's Medicaid program, offering health coverage for low-income individuals and families. Through December 31, 2025, many categories use the income-only test, meaning your savings and property did not count. That changed on January 1, 2026, when asset limits were reinstated for certain programs like long-term care. Your timing matters. If you might need Medi-Cal soon, it's better to explore your options now than later. There are ways to apply for Medi-Cal now and keep it later by using certain tools that we'll describe in a different video. And finally, rules vary by county and by program. Don't assume you're eligible until you check. This is a statewide program, but the program is administered by people, and some people make different decisions in different counties. So make sure that you double check before you assume anything. What can you do next? Start by checking your income and assets now. Keep good records, especially if you think that you'll need long-term care in the next few years. Make sure that you understand what you spend, what you earn, what you could keep, and what you can afford to give away. And follow along in the next video in this series. We'll cover topics like estate recovery, long-term care coverage, and how to protect your assets while qualifying for Medi-Cal. If you've made this far, thank you for watching. Don't forget to like and subscribe so you don't miss any of our videos. Share this video with someone who you think could use this information. And follow along to help us deal out the keys to your links.